Breaking news: HMRC is gearing up to reach out to nearly 900,000 savers across the UK. If you happen to have over £3,500 sitting in a fixed-term savings account, you could already be on their radar. Many individuals mistakenly believe that their savings are exempt from taxes, thinking that only the money they deposit is safe. While that's true for the principal, the interest accrued is a different story. With interest rates on the rise, a little-known tax trap is ensnaring countless unsuspecting savers. The crux of the issue lies in the taxation of interest earned from fixed-rate accounts. If your account pays interest only at maturity, whether that's after 2 years or 3, all of that accumulated interest is classified as income within a single tax year, despite being built up gradually over time. This means that a basic rate taxpayer earning over £1,000 in interest in a single year will find themselves owing tax on any excess. Higher rate taxpayers are at an even greater disadvantage, as their allowance is capped at a mere £500. For additional rate taxpayers, there is no allowance whatsoever. So, while a balance of £3,500 in a 3-year fixed account yielding 5% annually may not seem significant, the lump sum interest payout could easily push a higher rate taxpayer over their limit. For basic rate taxpayers, the danger zone begins at about £7,000 under similar conditions. Recent research from Paragon Bank reveals that around 2.44 million fixed-term non-ISA accounts are set to mature within the next 3 months. Alarmingly, of those, approximately 887,000 will generate enough interest to create a tax liability. This is no trivial matter. It's a significant concern, especially since many are blissfully unaware that they've crossed the threshold. The confusion surrounding tax stems from a widespread misunderstanding. Most savers assume that interest is taxed as it is earned, but HMRC only considers it taxable when it becomes accessible. So, if your 3-year account pays out nothing until the end, all that interest is counted as income for just 1 tax year, regardless of how long it took to accumulate. Laura Sutter, a personal finance expert from Ajabel, warns that many are unwittingly heading for a tax headache. She emphasizes the necessity for savers to grasp precisely when and how their interest is paid. If it's all dispersed at once, it could push them over the edge, even if they possess just one savings product. To mitigate this risk, she advises selecting savings accounts that pay interest monthly or annually, allowing for a more manageable distribution of returns across several tax years. This approach helps keep income within taxable limits. Alternatively, the safest route is to opt for a tax-free cash ISA. These individual savings accounts permit you to earn interest on up to £20,000 annually without incurring any tax. In today's climate, that tax shelter can be a game-changer, especially as more savers find themselves unexpectedly thrust into the taxable sphere due to rising interest rates. Derek Sprawling, Managing Director of Savings at Paragon Bank, points out that over 500,000 savers could have sidestepped tax bills by utilizing a cash ISA instead of a standard fixed-term account. With more accounts maturing daily, the opportunity to make a savvy switch is dwindling. Receiving a letter from HMRC won't result in a fine, but it will serve as a warning. HMRC may adjust your tax code to recover what you owe, or you may have to complete a self-assessment return. Ultimately, the onus is on you to remain informed and compliant, particularly if you're balancing multiple income sources or teetering on the edge of a higher tax bracket. It's no longer feasible to adopt a set-and-forget mentality with your savings. As interest rates rise and tax regulations remain static, more savers are falling prey to the misconception that their tax-free benefits are more substantial than they are. What was once a concern limited to the wealthy is now impacting everyday individuals, retirees, young professionals, and even students with modest savings. So, what should astute savers do right now? First, assess your tax status and identify your personal savings allowance. Basic rate taxpayers have a £1,000 buffer, but be sure to include all your interest from every account. If you're in the higher bracket, your allowance drops to £500. For additional rate taxpayers, there's no margin for error. Next, review your current savings accounts and scrutinize how the interest is structured. If it's paid out at the end of the term, you could be on the brink of incurring a tax liability without realizing it. Third, seriously consider transferring your funds into an ISA, particularly if you haven't yet utilized your £20,000 allowance. Finally, keep meticulous records. Many banks do not automatically report your savings interest to HMRC unless it surpasses certain thresholds. Thus, it's your responsibility to track, report, and pay taxes as necessary. Utilizing a personal finance app or spreadsheet can help you stay ahead. If your saving strategy is intricate or your income fluctuates from year to year, consulting with a tax advisor could save you from unnecessary penalties down the line. Another lesser-known strategy is to distribute your savings across various products or even between spouses if applicable. If one partner is in a lower tax bracket, shifting savings to their name could yield a more favorable tax outcome for the household. Furthermore, younger savers aiming to buy their first home should explore lifetime ISAs, which offer a government bonus and remain tax-free. In conclusion, saving money remains a prudent choice. However, in this evolving landscape where interest rates are finally climbing after years of stagnation, the rules governing how your interest is taxed are catching up rapidly. That lump sum payout from a fixed-rate account, which seems like a windfall, could turn into a hidden tax burden. Awareness is crucial. Don't fall victim to outdated rules in a modern economy. Don't rely on your bank to manage everything for you. Instead, take charge, stay informed, and optimize your savings to navigate today's financial realities effectively.